Hi there, and welcome to part 2 of the 7 most difficult Series 7 top-off exam topics, brought to you by Professional Exam Tutoring. In this video, we're going to cover the remaining topics that we didn't get to in the last video, primarily fundamental analysis, suitability, stop limit orders, as well as margin calls and calculating the market value of an account when a margin call is necessary. Okay, so let's jump right into it. We ended the last video talking about how we will discuss the slobs over bliss acronym for the stop limit orders, but before we get into that, we wanted to start with the fundamental analysis section. This section usually causes a lot of headaches for people because anyone without an accounting background may have some difficulty here, because the first thing you want to really do is get very comfortable with the income statement and balance sheet. We highly recommend getting a sample of these, write them out a couple times each, just like you did when you were in 5th grade, and really just pound it in and make sure you've got exactly where sales go, expenses go, taxes go, and that's specifically for the income statement. Then for the balance sheet, knowing where the current assets versus current liabilities, long-term assets versus long-term liabilities, etc. go, and where the shareholders' equity is placed, along with what it contains. Now, once you have all of that in place, then you can move on to the ratios, and we're going to jump right into the ratios here, because this cheat sheet is really to give you a kind of quick understanding of what you need to know for the Series 7 top-off exam in the fundamental analysis section. And we want to make sure that you have a thorough understanding and you can backfill any gaps that you have, either with our own video courses or feel free to reach out for tutoring. Okay, for the first example, we have the DEF company that expects a surge in demand next quarter and decides to buy 12 new delivery trucks to prepare for the increased orders. Now, how does this action change working capital? Now, we give 4 options here, just like you would see on the regular exam. It would increase working capital, decrease working capital, there'd be no change, or there's not enough info. So these are our choices. Now, remember that the formula for working capital is current assets minus current liabilities. So when we see current assets minus current liabilities, what we need to do here is identify where are the current assets in this question and where are the current liabilities. Now, if we see that the DEF company has purchased a bunch of new trucks, and the question itself here is not specifying that they bought the trucks on credit or they took out a loan for it, then we would assume that they paid cash for these trucks. Okay, so what we need to do is identify where the cash is going to come out of. And we know that cash falls under current assets on the balance sheet. So current assets would decline. And the other item that's going to be impacted when you buy delivery trucks would be fixed assets, because trucks would count as a long-term asset, and they would also fall under the category of property, plant, and equipment. Probably equipment would be the most appropriate line item for delivery trucks. However, given that we're trying to figure out what the impact is on the working capital formula, we know that fixed assets or long-term assets are not included in this formula. So with a decrease in current assets, because cash is going down, and no change in current liabilities, we would expect this overall ratio, or this overall formula of working capital to decline. So if we assume that the trucks cost $1 million and we paid them in cash, and before, let's say we had current assets of $4 million, current liabilities of $2 million, that would leave us with $2 million in working capital. And perhaps afterwards, we would have $3 million because we paid cash of $1 million, and we still have $2 million in current liabilities, which actually decreases our working capital to $1 million. And remember that trucks are fixed assets, so the increase in fixed assets is not showing up here in the working capital. Therefore, the only decrease we see in working capital is a decrease of $1 million, or a decrease in current assets and no change in current liabilities, which would overall take down working capital. So the answer here we would expect to be B, a decrease in working capital. Okay, for the next one, how does this action change the current ratio? Well, the current ratio is very easy to remember because it is the current assets divided by the current liabilities. So when we're doing the current ratio, we are going to use very similar components to the working capital formula, as you can see here, but now it's a ratio. It's not an addition subtraction type of question. Whenever you have a question asking you for a ratio, right off the bat you know it's going to be a division problem, because a ratio involves one thing divided by another. So when current assets are divided by current liabilities, we know that we have to divide current assets, which in this case we decided was $4 million in our example, and we would divide that by $2 million, which we said in our previous question that the hypothetical current liabilities was. And if we said the current assets are decreasing because we're paying out cash, remember, and cash is a current asset, current assets come down to $3 million, but again, no change in current liabilities. So our ratio goes from 2 to 1.5 because we had 4 million over 2 million, which equals 2 before, and now we have 3 million divided by 2 million, which equals 1.5. So the current ratio also happens to decrease, which leaves us again with the answer B. Now the next question is, what happens to the quick ratio? Very similarly here, the quick ratio is quite close to the current ratio. However, there's one item that you need to remove. We take out inventory from the quick ratio, or from the current ratio, in order to get the quick ratio, but we're just doing so from the numerator. So current assets subtract inventory, and that leaves us with a very, very liquid form of current assets, because inventory are somewhat liquid, but not as liquid as accounts receivable or cash, which can be very easily changed into cash. So the quick ratio really gives you a sense of how easily can you meet your current liabilities given the things closest to cash that you have on hand in your current assets. So here, current assets minus inventory divided by current liabilities. We're going to see a very similar type of situation to before. The trucks, remember, cost us $1 million that we paid in cash, and let's assume now that our inventory is $500,000. So if that's the case, we have before the transaction happened, 4 million minus $500,000 divided by 2 million is 1.75, and after we would have 3 million minus $500,000 because the inventory didn't change. The trucks, remember, are counted as long-term assets, not short-term assets or inventory. So we divide that again by 2 million because current liabilities did not change, and that leaves us with 1.25, which again is a decrease overall, and thus the answer is B. The quick ratio decreases when the company buys new trucks, which it pays cash out for. Okay, and the last question here is, how does it impact the debt to equity ratio? Well, here we remember the debt to equity ratio as debt divided by equity. And since we paid $1 million in cash for the trucks, we actually decreased our cash by 1 million, but we increased our truck asset by 1 million. So overall, there's no change in assets. And remember, assets minus liabilities equals equity. And since assets are not changing, and we know that liabilities didn't change because we didn't borrow any money to buy these trucks, the whole equation, assets minus liabilities, will not have changed at all. And remember again here, cash dropped, but the truck asset increased, so therefore there's no change in the debt to equity ratio. Okay, now we're going to move on to suitability. Suitability is a very important section with the Series 7 top-off exam. We highly recommend that you really concentrate on this section. That's why we've included this section along with a number of practice questions in this Series 7 top-off cheat sheet. Now, it is among one of the most difficult topics for the Series 7 top-off exam for some people. Others find it a little easy. Wherever you fall in this process, you still want to make sure you give it plenty of focus because it comes up quite a bit. It involves a two-step process, and that's how we break it down in our lessons, online, in person, as well as through our video courses. The two-step process includes first using the 100 rule, or what we call the 100 rule, and then next would be identifying specific context and using keywords. The 100 rule we'll get into, but basically you take 100, you subtract the age of the investor, and that leaves you with the percent of investments that should go toward equities, with the remainder going toward bonds. So remember that 100 minus age equals the percent in equities, and the rest goes towards bonds. And step 2 being identify context. That means you want to consider things like situation, how wealthy the person is, are they single, are they married, are they widowed. You also want to consider things like their goals, their investment goals, their targets, where they want to be in 5 years, 10 years, 20 years. And then another thing you want to consider also is emotion. You want to make sure you're accounting for the fact that there's emotion involved in investing. Can they handle it? Are they risk averse? Are they an aggressive investor? And are there any keywords in the question such as they're concerned with something or they're worried about something? So we'll take a look at that in the next couple examples. So example 1, Joel is 20 years from retirement and just inherited $400,000 from his deceased uncle. He has no retirement savings and no pension. He wants to maximize his retirement savings with this money, but with no other retirement plans, he's worried that he will outlive his savings. What would be his best option? Okay, now let's take a look at a couple keywords here. So first, the fact that he's 20 years from retirement gives us an idea that he's got to be somewhere maybe in his 40s if the average person retires somewhere in their 60s. So he's got some time, not a lot of time, but he's got some time. So that's one thing to consider. We also consider the fact that he just inherited $400,000. This would give him a little more leeway to be slightly more aggressive with his investments. He's not an uber millionaire, multimillionaire, or billionaire, so he doesn't have a ton of extra savings or wealth built up, but it does give him a little bit of ability to take on some risk. He wants to maximize his retirement savings. Anytime you see the keyword maximize, that's usually a good indication that he may be looking for growth. And when we see the word growth or maximize, that's typically associated with stock investments. So anything that has stocks in them typically are looking to grow over time or maximize returns, and they tend to grow faster than bonds, as well as things like fixed annuities or preferred stock. The last thing to keep in mind is that he is worried he will outlive his savings. Outlive his savings is another kind of key term that should raise a flag when you see that. If you're worried about outliving your savings, that means you don't think you're going to be able to save, and you're not going to have enough saved or have enough grown in your investments to last until you pass away. So in that case, you might want someone else to do the calculations for you to make sure that you're just taking out just enough money so that by the time you pass away, you still maybe even have some money left, or you've just depleted just enough of your savings. Now, of course, this is extremely complicated and involves a lot of calculations, so you may not want to leave it to yourself, and as a result, many people leave it to insurance companies. And as soon as I mention insurance companies, another flag should go off that potentially we're talking about annuities here. So the two that you can see are the best options in terms of annuities would be A and C, because those would be the only two annuities that you would see here. So we've broken it down to A and C because an annuity is going to give you a certain specific payment, or it could be a variable payment depending on if you have a fixed annuity versus a variable annuity over a period of time and potentially for the rest of your life. Now, to decide between a fixed annuity versus a variable annuity, we want to revisit what exactly this investor is looking for. If he's looking for very predictable and very steady Eddie type of payments, then we're going to go with the fixed annuity. If he's looking for some type of growth, then we're going to go with variable annuity, because the variable annuity has a stock component, whereas the fixed annuity does not. Now recall, he wanted to maximize his retirement savings. That's what we said was the indicator that he's going to want some kind of growth or stock investments in his retirement savings plan. And the only one that we know has that between fixed annuities and variable annuities is the variable annuity. So that would be our answer. Okay, example 2. A wealthy 39-year-old New Yorker just sold her third home in the French countryside and asks her registered rep what she should do with the proceeds. Growth is a priority for her, but she also wants some current income for living expenses. She does not plan to buy another house anytime soon. What would be the best recommendation? Now, here again, we're going to start with the age rule, or the 100 rule. So we see we have an exact age this time to deal with. So 100 minus 39 is 61. So we know that approximately 60% she can allocate toward stocks. The other 40% may be something toward, maybe an investment toward bonds. Now, a few things we can point out here. We've already covered her age, but we can also see that growth is a priority for this person. One thing we kind of skimmed over here is that this is her third home, and it's in the French countryside. Presumably, she is fairly wealthy or does fairly well for herself. And so we know that she may be in a higher income tax bracket. We'll table that for a second, but we'll consider that a little later. Now, she also wants some current income. So she wants some growth and current income. Growth, remember, is telling us that she probably wants something stock related or some kind of stock investment. But if she wants current income, that's also got to be balanced by something that's going to produce either some types of dividends, such as preferred stocks, or some type of income like coupons or some kind of payment from fixed income securities. Now, she does not plan to buy a house anytime soon, but what we do know here is that she's going to be looking for a bit of a mix between stocks and bonds. So let's take a look at our options. So the first one here, we see 55% money market fund, 10% New York State bond fund, 30% mid-cap growth fund, 5% cash. This one's fairly conservative. 5% cash plus 55% money market fund, that's 60% in really conservative cash-like investments. She's probably not going to need that because she can afford to invest in 60% stocks. So we'll drop that one for now. 40% mid-cap growth fund, that's a stock fund. 20% index fund, that's another stock fund that's mimicking the stock market index. And then 30% New York State bond fund, 10% revenue bond fund. Both of those are munis, so that's pretty interesting for the moment. 80% New York State bond fund, that's a huge amount in munis. 10% small cap growth, that's stocks. 10% money market, that's basically like a savings account, quite conservative. So 90% here is going in some bonds and a money market fund. That seems a little too conservative for this woman. Now, D, 25% fixed annuity, 25% variable annuity, 25% treasury bond fund, 25% mid-cap growth. The mid-cap growth is the only thing here that's totally stock related. There's some stocks we know in variable annuities. However, it doesn't seem to be enough to add up to about 60%, which is something that she would probably be appropriate for her in terms of investment. The only thing that we really see that lines up with that would be the 60% here in B. And the other thing that really reaffirms our decision is the fact that she's a New Yorker, and the revenue bond, which is a muni bond, would have some tax benefits, but also the 30% New York State bond fund would also have tax benefits. She would be totally tax exempt on these, and that's very good for a wealthy person that would be in a high tax bracket. So we would pick B for our answer. Okay, moving right along. Now let's get into stop limit orders. So a quick reminder, the slobs over bliss acronym is a very important acronym to remember for this section. For those of you that don't remember, let's take a quick trip down memory lane. So the market price is the part that we have in the middle between slobs and bliss acronym. If we have slobs in on the top, we have slobs over bliss, remember, slobs being the sell limit or buy stop, and then bliss being buy limit or sell stop. Now the significance of the order here is that when with slobs over bliss, slobs is indicating that it's or slobs on top is indicating that the market price of the stock should be trending upward, and that's when you would want to set a slobs type of order, so a sell limit or buy stop order. However, if the price is trending downward, you would want to set a buy limit or sell stop order. So these would be the price's trends or where you're expecting the price to go. Now, the other thing to consider would be in terms of the market price, if you're going to set a sell limit, you're going to set a sell limit above the market price, and or you're going to set a buy stop order above the market price. Now when it comes to a buy limit order, you're going to set that below the market price, and when it comes to a sell stop order, you're going to set that also below the market price. So slobs orders are set above the market price, bliss orders are set below the market price. Now let's get into one of the hardest parts of the order type of questions, and that's when we have a sell stop limit order, or a stop limit order in particular, but in this case we're doing a sell stop limit order, where there is a different stop and limit price. So let's visually take a look at what this might look like. So you may decide to buy a stock around $18 per share, and you think it's going to eventually go up, but there's some point where you think, well, it might actually start coming down again, and you want to protect yourself before it comes all the way down. However, you don't want to just sell it as it's coming down at any price. You have a very specific price in mind where you want to sell it. So if this stock has come up to 22, it starts curling back around, you're getting a little worried, you decide, you know what, I want to sell this stock if it hits 20, but I don't want to sell it at 20. I want to sell it for a little above 20, and not even a little above 20, but somewhere above 20.50. So what you do is you set a sell stop limit order where the sell stop order is for 20, but the limit part of that order is for 20.50. So how this may look is that you set your stop order here at 20, and you've set your limit order a little above it at $20.50. Now remember, it's going in the right direction because we first start out with the sell stop order, and we take it in order of how it appears in the question, and it always is going to be stop limit. Stop limit orders are always starting with stop and they will end with limit. So you treat it like a sell stop first. We know sell stop is bliss, so it's got to be trending downward because slobs over bliss. Bliss is going down. So we see 20, 20, 20, 1990, 1875, and then as it starts curling back up, it's going to turn into a limit order. So let's see how this works. So a sell stop order, it's got to be coming down. Once the stop order is triggered at 20, then the trigger happens and now it becomes a limit order. Now for a limit order, sell limit order, that's slobs. So that's got to be slobs over bliss. Slobs is on top. It's got to be trending upwards. So 2020, $20, 1990, 1875, and now it starts curling back up. It goes above 20 to 2005 and goes above 2050 where we set our limit order, and it hits 2055. So that would be the execution price. So for a stop limit order, the first thing we're going to do is going to have it hit a trigger. Once this trigger goes off, then the next thing it's going to do is turn into a limit order, and the sell limit order is going to execute at the price indicated or better. So remember, limit orders are executed at certain at the price specified or better, whereas stop orders typically just create a trigger first and then they execute afterwards. Stop orders on their own would execute at the market price, but a stop limit order would go trigger first and then execute later based off of the limit price. So limit price or better. Okay, the last topic we're going to discuss in this cheat sheet are margin calls. Margin is a section that creates lots of headaches, so we'll hope to relieve one of those in this example. Now, this specific example doesn't just have to do with margin calls, but it has to do with calculating the market value where you will get a margin call. This confuses a lot of people because they usually read the question as just calculate what the margin call should be, when they are actually asking you what is the market value that will trigger a margin call. So let's take a look at this question. A registered rep's client asks him what market value of his long margin account will trigger a margin call. The client's current market value is $15,000, while her debit balance is $9,000. Okay, so the first thing we want to do is determine what equation we're going to use. And to really determine what equation we're going to use, we're going to go back to deciding when does a margin call occur. Well, we know a margin call occurs when the maintenance margin is equal to equity. If the equity dips below the maintenance margin, we get a margin call. Now the equation for the maintenance margin would be 0.25 times long market value, or 25% times the long market value. And the equation for equity in a long market value, in a long account, would be long market value minus debit. So we can see here that if we rearrange this equation, we get left with long market value equals debit over 1 minus 0.25. Now, if this seems a little too complicated to run through, then don't worry about it. All you really need to know is debit divided by 1 minus 0.25, or quite simply, debit divided by 0.75. So in a question like this, it actually becomes fairly straightforward because you just need to identify the debit balance. So they're asking what the market value would be in this long account that would trigger a margin call. And in that case, we know the debit balance is $9,000. And the formula is debit divided by 0.75. So we do $9,000 divided by 0.75. And that gets us to $12,000. So therefore, in order to trigger a margin call, this account would have to go from $15,000 down to $12,000 before a margin call would be triggered. Okay, well, that's about it for our 7 most difficult topics on the Series 7 Top-Off exam. If you'd like a little more on these topics and more, check out our video courses at www.professionalexamtutoring.com, or if you're looking for private tutoring, feel free to email me and we can set you up either with myself or some of our other great tutors at jim@professionalexamtutoring.com. We hope to see you soon.